From the glass towers of Frankfurt to the wind-swept coasts of the North Sea, Europe in 2025 is not just changing, it is reinventing itself. The continent's long-promised green transition has moved beyond the language of policy documents and press releases and into the daily realities of its industries, households, and financial markets. The European Union's ambition to become the first climate-neutral continent by 2050 is no longer an abstract goal. It has become a structural force that now defines the rhythm of economic life. And like any transformation of this magnitude, it comes with both opportunity and tension, prosperity for some, discomfort for others, and an entirely new definition of competitiveness for all. As a financial analyst watching these developments unfold, I see a region that is simultaneously burdened by the costs of change and energized by its potential. The green transition is not a single policy or a set of environmental goals. It is an economic revolution, a profound reallocation of capital, resources, and priorities. It challenges Europe's traditional growth model and compels it to balance the competing imperatives of sustainability, security, and social equity. The first visible impact of this transformation is on Europe's industrial landscape. Traditional sectors in energy, manufacturing, transportation are being fundamentally reshaped. Coal plants that once powered entire regions are closing. Steel and chemical companies are forced to modernize or die. Automakers are shifting from combustion engines to electric fleets, investing billions in battery production and renewable energy integration. Germany, once the fortress of industrial reliability, finds itself recalibrating its entire value chain around decarbonization. France bets on nuclear as its anchor of energy independence, while Spain and Portugal emerge as unexpected winners, transforming their abundant sunshine into competitive advantage through massive solar infrastructure. But this shift is not without pain. Energy prices across Europe remain higher than those in competing markets like the United States and China, where production is often powered by cheaper fossil fuels. This disparity strains competitiveness, especially in energy-intensive industries such as aluminum, cement, and automotive manufacturing. European firms, while technologically advanced, face a brutal arithmetic. How to sustain profits while complying with one of the world's most demanding environmental frameworks? Many turn to innovation, energy efficiency, recycling technologies, carbon capture, as their survival strategy. Yet, as with all transitions, not everyone can keep pace. The geopolitical dimension of the green transition adds another layer of complexity. The war in Ukraine accelerated Europe's break from Russian gas, forcing the continent to rapidly diversify its energy sources. Liquefied natural gas, LNG, imports from the United States and Qatar now fill much of the gap, but at a steep cost. The short-term strain is evident in household energy bills and industrial input prices, but strategically, Europe's dependence on unstable suppliers has diminished. The crisis that once exposed Europe's vulnerabilities has now become the catalyst for its transformation. The continent's energy independence, once an elusive dream, is gradually becoming reality, driven not by ideology, but by necessity. In financial terms, the numbers behind Europe's green transformation are staggering. According to European Commission data, over 600 billion euros in public and private investment has been mobilized under the Green Deal framework. The financial sector is undergoing a silent revolution. Capital is flowing towards sustainable projects at an unprecedented pace. Green bonds, ESG funds, and sustainability-linked loans have become the new normal. For financial analysts, this means that understanding the green premium, the differential return and risk associated with environmentally aligned assets, has become essential. The markets are learning to price carbon, not just in emissions, but in opportunity. Still, not everyone shares the enthusiasm. In boardrooms and parliaments, debates rage over whether Europe's green ambitions risk undermining its competitiveness. Critics argue that the regulatory burden is suffocating innovation, driving companies to relocate production to less restrictive jurisdictions. They warn that the so-called green bureaucracy, layers of compliance, certification, and ESG reporting, may slow down the very progress it seeks to accelerate. Yet others see in this discipline a long-term advantage. By setting the highest standards now, Europe ensures that it will lead in the industries of tomorrow. Indeed, some of those industries are already emerging. The renewable energy sector has become one of Europe's strongest growth engines, employing millions and attracting record investment. Offshore wind, once an experimental concept, now powers millions of homes. Hydrogen, like still a work in progress, but is quickly moving from pilot projects to industrial-scale reality. The electric vehicle ecosystem, supported by vast networks of charging stations and battery plants, has become a symbol of Europe's ability to adapt. These sectors are not just environmental initiatives, they are economic ones. The foundations of a new industrial era built on sustainability rather than extraction. The green transition also redefines Europe's relationship with technology and innovation. Startups specializing in carbon-neutral materials, AI-driven energy optimization, and circular economy logistics are proliferating. Venture capital that once flocked to Silicon Valley is increasingly looking to hubs like Amsterdam, Berlin, and Copenhagen. Governments, for their part, are finally aligning fiscal policy with green objectives. Subsidies, tax incentives, and research funding are driving a wave of eco-innovation. The challenge lies in ensuring that these benefits reach small and medium-sized enterprises, not just multinational giants. Yet, as a financial analyst, I cannot ignore the social dimension of this story. The transition, while visionary, is uneven. The shift away from fossil fuels threatens thousands of jobs in mining and traditional manufacturing. Regions like Poland's Silesia or Germany's Ruhr Valley face difficult transformations, where economic restructuring meets human uncertainty. The European Union's Just Transition Fund aims to cushion the blow, but no financial mechanism can fully replace the security of generations-long livelihoods. For Europe to maintain political stability during this transformation, it must prove that the green future is not just sustainable, but fair. One of the most fascinating consequences of the green agenda is how it reshapes Europe's monetary and fiscal philosophy. The ECB, once narrowly focused on price stability, now incorporates climate risk into its balance sheet assessments. Central banks discuss carbon exposure with the same seriousness they once reserved for inflation. Monetary policy, traditionally agnostic to environmental issues, is slowly evolving into a tool of structural transition. Fiscal policy, meanwhile, is being redefined by green investment targets and energy-resilient spending. The pandemic blurred the lines between fiscal and monetary action. The climate era is redrawing them permanently. The private sector, too, is adapting its mindset. Where investors once demanded short-term profit, they now seek long-term sustainability. Environmental, social, and governance (ESG) metrics, once viewed as public relations, are becoming determinants of capital flow. Shareholders demand accountability. Consumers reward transparency. This cultural shift, subtle but pervasive, is perhaps the green transition's most profound achievement, transforming capitalism itself from within. Still, there are warning signs. If mismanaged, the transition could widen inequality both within and between nations. Wealthier member states can afford to subsidize green industries. Poorer ones struggle to finance basic adaptation. Energy poverty, once confined to Southern Europe, is now a concern across the continent. For the green transition to succeed, solidarity must extend beyond rhetoric. Europe's unity will be tested not by the boldness of its goals, but by the fairness of their implementation. From an analytical perspective, the next decade will determine whether Europe's green agenda becomes its economic renaissance or its overreach. The early evidence is mixed but encouraging. Emissions are falling faster than expected, renewable capacity is expanding exponentially, and capital markets are aligning with sustainability principles. The challenge is scale. Can Europe maintain momentum without exhausting its fiscal capacity or alienating its citizens? In the end, the green transition is not just about carbon neutrality. It's about redefining what growth means in the 21st century. For decades, progress was measured in GDP, industrial output, and consumption. Now, Europe is experimenting with a new metric: resilience. Economic power no longer rests solely on what you produce, but on how sustainably you produce it. The continent that once built empires on coal and steel is now building a new one on wind, data, and trust. As I look at Europe's trajectory, I see a region in transition not only technologically but morally. It is learning to balance ambition with humility, profit with purpose. The green agenda may have started as an environmental necessity, but it is becoming a defining principle of Europe's identity, an experiment in whether capitalism can be both profitable and conscientious. If the 20th century belonged to the economies that mastered extraction, the 21st will belong to those that master regeneration. And in that sense, Europe, for all its challenges and contradictions, might once again find itself leading the world, not by sheer economic might, but by proving that sustainability and prosperity can, at last, coexist.